One of those risks is really what we're seeing with this accelerated, in a lot of ways, unprecedented sell-off in the bond market. At what point does that become a reality check for stock investors, which have kind of almost been using equity trading as an inflation hedge?
Absolutely. Look, what's also incredibly interesting is that what's really led the market rally in the last couple of weeks was the growth stocks or your tech companies,
right.
And that has been sold off enormously. And these are the companies, because they're long duration, a bit like bonds, they tend to be sold off when market go through this sort of gyration. Look, it will catch up. It was a bit of rebalancing after a couple of months, really tough month for those growth companies, and very soon, some of those uncertainties will catch up, will play out. We still got the war going on, we've got commodity price spike, and we got all the inflation prints. It will catch up, and particularly as we move closer to the potential 50 basis point increase in the next month or so, the market will start sort of trying to price in what does that mean. So it's interesting times.
So how are you positioning right now? Are you still long commodity, long energy exposure?
Yeah, our strategy is that because we can go long shorts, we tend to keep reasonably neutral, but certainly those energy space and commodity, they are going to be the beneficiary of what is to play out, particularly energy equities. At this point, the share price hasn't moved up as much as the underlying commodity prices. So on that basis, these companies will do quite well in terms of cash flow, in terms of dividend. But for us, a lot of important things, we tend to look at the sector that's out of favor. So that's a growth company we've been talking to, but not your traditional, what do I call it, the spicy growth company doesn't make cash flow. It's really back into the likes of healthcare, where they will provide structural growth without the need for the economy to sustainably be higher for a very long period of time. And I think these will come back in favor at some point.
Is that commodities play why you're optimistic about the Australian equity market despite your broader caution on stocks?
Yeah, look, the Aussie equity market, partly, Aussie equity market, as you said, it was well positioned because of our exposure to commodities and some financials. So in this environment, they should do reasonably well. But also Australian economy, we sort of have lagged in terms of growth in the last couple of years, simply because we had very strict lockdown restrictions. So, we really just playing catch up. So our, corporate earnings is going to grow high double digits over the next 12 to 18 months. Taking out the resources company. So things are looking okay. At the same time, our inflation is not yet run away like the ones experienced like the US. Our underlying employment market is structurally different. Two-thirds of our employment space is really is under awards and things. So it doesn't price doesn't rally as fast. So on that basis, we're looking pretty good, the Australian market.
How is the Japanese market looking? Because last year there was a lot of optimism given its sort of cyclical tilt, and we're now seeing this weakness in the Japanese yen as well. Will that help?
Look, certainly will help, but look, unfortunately, what is to take place in terms of trade and the like, they are going to be, a little bit challenged.